Welcome to the NGEN Markets training session. While others are joining in, we would start with our, the topic which we are going to have today. So today our topic is comparing diversified portfolios, and then we will have Q&A. So diversified portfolios, in the sense, we will talk about mutual fund stocks and even non-standard asset classes. So we will compile such, assets and show you how the portfolio works out in that particular domain. So I hope my screen is visible to everyone and my voice is audible. So hopefully we can start with our session altogether. So let's go ahead with our terminal. I'm just sharing my different screen. Just a moment. I hope my screen is visible to everyone. If it is not, please let me know, and then we can address this. So accordingly, for portfolio diversification, we normally add, mutual funds and equities and even debt mutual funds in our kitty of the portfolio. But there are other assets as well that can be easily be added into the NGEN Markets terminal. So to add them, all you have to do is you have to click on this add a new portfolios. So let's say we already have a couple of funds in our place. So let's say we are adding these funds, via CDSL, NSDL, CAS, PDFs, and we can see these are the funds, mutual funds, essentially all the equities added into the portfolios, new portfolios section. Now we can add in stocks from here. So let's say we add an ICICI Bank, and then we can also add in Customize Securities. So to add in Customize Securities, we have already given a demonstration before that how to add in Customize Securities. So I'm just adding couple of stocks which I've actually added from Customized Securities. I'm adding PayPal and I'm adding JP Morgan. So as you can see, it is getting a bit diversified because of foreign equities in the place. And here, as you can see, you can actually run this hypothetical portfolio which I've constructed in front of you. So that's how you can actually construct a couple of portfolios based on any particular assets added into the system. So for customized securities, all you have to do is come into this custom securities, and to add them, as you can see, these are the three stocks I've added currently. You have to, copy and paste the price series number of that particular asset. So you can even add, PMS, AIFs with their price series, or you can also add in, a couple of foreign securities and even crude oil and commodities as well. So there are lots of things that can be added into the entire set of the custom securities. It's a very underrated function which you can use, and then you can actually add them into the portfolios. To add them, all you have to do is just come back again. I'm just showing you again how to add them, and I'm adding Marsilius King of Capital, and that's how it is added, and you can run this. So this is pretty seamless to add these securities into the section. Now let's review these portfolios, and then we will compare it with couple of portfolios and show you how a diversification is very important and how you can actually convey comparisons and actually acquire a client. So for essential portfolio, I've actually made one of them prior to this meeting. So one of them was given here, a diversified portfolio. I'm just going to run this. So it includes a couple of foreign stocks. It includes a couple of equity funds, and also it includes a couple of ETFs. And then what I have to do is just have to run this portfolio and to see how this portfolio is backtesting based on the current holding which we have right now. So one important note to be taken here is that it is very important to check what we hold currently and not to see what transactions have been happening from the last couple of years for the clients, because the transactional analysis, which is attributions, gives us the idea about what type of decision making you have done in the past. But for a forward looking nature, only things we should look for is the current holdings which you hold today, so that you can take a call for tomorrow and for the next couple of years, that what a client should be taking positions in, uh, based upon the historical performance and all those parameters which is given in this particular analytics. So this is how you can look towards the analytics which is given by NGEN Research. Is that one of the important thing is to look towards asset allocation. As you've added customized securities in detailed view, you can just click on others and see these are the custom securities which have been added. And here you can click on this I button to see where it is coming from. So it's an exposure, it's a direct holding a client has. And also you can look towards the foreign equities. So as a matter of fact, you can actually check from this I button that which particular, fund or an ETF is actually, backtesting and giving you that particular asset exposure. So that's how the overview section works out. And, looking towards the concentration is very important, because my top three concentration is pretty high, 23%. And which are these top three concentrations? So you can just click on this show all, and you can actually see these are the three, foreign stocks which I hold, which are having the top three concentrations. So it's a risk for me, because these three stocks can actually define what kind of a risk I might be exposed towards for a 23% of my portfolio. So that is how you can look towards a diversified portfolio. And one more important thing is looking towards correlation. A correlation analysis gives you a lots of insightful information as to how diversified your portfolio is based on the relationship between the two assets. So one of the key use case we are going to look towards is Visa and JP Morgan. As you can see, they are both, inclined towards the similar financial, domain, and you can see they are having a good amount of correlations altogether based on this particular stock. Whereas if you check in for, any other, parameters, you will definitely see there are no such correlations with other, funds as well. Let's add in some Indian equities to see if there is some correlation between foreign equities or not. It's just a use case. Do it for your own research purposes. I'm just adding an ICICI Bank, and I'm running this. So once I run this, based on this, I can actually check the correlations between a foreign stock and an Indian stock as well, to see if the correlations are there or not. And if I can see any correlation, so you can actually take a call on based on that as well. So accordingly, that's how it is. That's how you can look towards. As you can see, this is ICICI Bank, and it is not correlating with any of the foreign stocks given here, and that will definitely not. But you can see the correlations of ICICI with other funds, and that's how the correlations works out. It doesn't look towards what the assets are. It only looks towards the price series of that asset. So no matter what, even if you add in a commodity as a custom security, or even if you add in any particular, PMS, AIFs, it will definitely show you the, particular correlation analysis. So, that's how you can look towards the diversification. If you want to see that if the client is diversified or not, is a very, important question altogether. So that is it for the correlation analysis. And one important analysis is contribution. So once you know that correlation is working out, you need to check what type of contributions you are getting based on the funds and the securities you hold. So it is very, very useful, because it shows you every single, securities and their contribution towards return in the portfolio. You can click on this graph, and you can actually see what is the allocation to the portfolio, and what is the, how much this fund has actually given as a return. And based on that allocation, it will give the contribution towards the return. And you can actually have a start date and end date to see the contributions altogether. So let's say hypothetically we are running some of the backtest here to see if the contributions between these two, dates, what was the contribution. So you can see DSV small cap and Canada and all others. So you can hypothetically backtest many dates. So as it is a point to point domain, you would definitely want to see the contribution based on that. So, and it is easily been downloadable in Excel. So that's how this works out for the contribution analysis. And yeah, definitely we do have stats to show you what kind of holdings we have accordingly in the portfolio. So it is very, very useful, because if I am holding mid caps, so is it necessary to have three mid caps, is a very important question. And also the two small caps, either way I can keep one of them and solve the same thing, having this portfolio. So accordingly, this is how the diversified portfolio works out. Now, one important question is, how about comparisons of the portfolio? Because comparing portfolios will give you a lots of ideas when you make certain changes into the original ones. So to go ahead with that, all you have to do is you have to click on compare to portfolios. And once you have done that, you can actually, add in any such portfolios which you want to compare with. So I'm just going to compare a simple model portfolio, based on Indian domestic, mutual funds and stocks. And then I'm going to compare it with my diversified one, which I've added some ETFs and, all other assets all together. So let me just, add in one of the particular, yes, let me just a moment. Yeah. So I've added this particular, portfolio, and I'm gonna add another one which with a particular, ETFs and so I will just search this one. Yeah. Yeah. So accordingly, you can see that these are the, comparisons between the two portfolios altogether. So I hope it is visible to everyone. You can have your own custom start date and you can see the annual return difference. So annual return difference shows you from this particular start date. That is how we are actually performed. We have actually performed on an annualized basis. And this is what it shows you accordingly, that every single year, what was our performance against the original, portfolio. And you can also see how our annual volatility is against the original portfolio. So in this case, you can see that volatility has decreased. We have a lesser volatility but a higher return, annualized return altogether. So that's how a diversified portfolio can actually, help you to mitigate risk and to stress test the portfolio based on the entire diversification, so that we don't over diversify, but we actually keep an essential, components inside the portfolio to keep it as suitable as possible for the client's portfolios. The next one is an asset allocation. The comparisons between asset allocation is truly simple. All you have to check is, what type of securities these particular portfolio holds, and you can also see the market cap exposures. In the matter of sense, this is, more, more in a general sense, it is better than this one, as you can see. And then you also have an exposure. This are, based on the domestic exposure and the sectoral exposure. In the left side, it is truly towards pharmaceuticals and healthcare, as you can see. Whereas in this side, we are truly towards, banking, IT, and finance. So what is our sector inclination is a very important question. So, we are trying to persuade some of the client to go towards to leave this pharma and healthcare and to come towards, banking, IT, and finance. So why is that? Why is this? Why are we doing this? To show the client that, maybe pharma was a good option like 2 to 3 years before, but currently, banking, IT, software are solid domains, solid sectors where you can actually diversify your portfolio upon. And then you can also see the rolling and returns analysis. What is the actual on the basis of 1 year period, which is 260. What you can do is you can check towards 1 year that what is the entire set of, average rolling analysis. And then you can look towards the drawdown analysis. Now drawdown analysis gives you an idea that what are the losses and how many days it took to recover for this portfolio. You can see the drawdowns are pretty similar, but one single thing which you can see is the big gray area this particular portfolio holds is actually the period of loss. And this is a truly huge period of loss which a client might have suffered if he had started his investment prior to that period. And that's, how you can convey that. So the portfolio which you have right now in the right side is actually a superior portfolio against this one, against the left side. And that's how a proper client acquisition will work out, with the proper comparisons of all the particular parameters based on the strength of the portfolio. So drawdowns is very helpful to look towards the strength of the portfolio. And if you want to look, how much recovery, how much are the top 10 recovery of any particular portfolio, all you have to do is run the portfolio and check the drawdown analysis. So a drawdown analysis, you can check for any such portfolios, even for your own clients' portfolios. And that's how the, drawdowns works out. Here you can see that a still ongoing recovery is actually 20% recovered. So here you can actually take up, you can just zoom it in and you can see the recovery has just started and 20% has actually been recovered. So that's how you can look towards the top 10 drawdowns, and you can also, screenshot these things up. So this is how, the comparisons of the two portfolios works out. Now, what about multiple portfolios? How you can compare multiple portfolios in one place? There is a way to compare multiple portfolios, and its way is to make them as custom securities. So, I'm just going to show you one use case here is to, download this price series. Once you have downloaded this price series, all you have to do is copy that particular price series of Excel into the engine custom security button, right? So here what you can do is you can just, I hope this is visible to everyone in the Excel format. Here I'm just gonna copy this from November 2009, and I am going to paste this into custom securities. Once I've pasted this, you can actually name it as a diversified portfolio, and then you can just validate it. Once you have validated, you can just save it, and that will be saved into your custom securities section. Now here, once you have done that, if you have done like for more than couple of portfolios, you can actually compare these portfolios into the compare section. So to compare them, all you have to do is come into the compare section, and here all you have to do is select those securities. So I hope it is visible to everyone. You can just select the securities directly like this. I'm just gonna type in the diversified portfolio, and that is added to the system. Now, once I've added that, I can actually add in my more strategies and my more model portfolios altogether. I'm just gonna add in couple of model portfolios here, and I'm just gonna add one of the client's portfolio as well. So easily you can, add in even PMSs and AIFs to compare them, all together. But accordingly, I'm just gonna add a standard portfolio and one of these as well. So yeah, so you can see these are 5 portfolios I've added, and now you can actually compare their sharp. Now here this will start with their own particular start date. To have your own start date, what you can do is you can just type in 2012 and just click go, and now you will have a sharp ratio which will show you that the diversified portfolio which we have is having a sharp ratio of 0.69 compared to the prospective client which is having a 0.47. So that's how you can actually use this in a comparison, and you can actually do a lots of comparisons based on a simple 1 year, 2 year, 3 year, 5 year, and 7 year format as well. So it's very easy to compare in these parameters all together. And one important thing is to actually check the risk versus return analysis, because based on the point to point analysis, let's say you're trying to see what type of risk our diversified portfolio is actually exposed towards. If we are having some foreign equities and some foreign exposure, some ETFs of Nasdaq, we are still uh, lesser riskier than these two funds, these two portfolios, and these two portfolios consist of all the domestic mutual fund, equity mutual funds. So it's pretty useful to actually compare such a portfolio, and then see what type of a risk do you have. Based on the risk, what type of a return are you generating, and you can actually change to check and stress test this entire model you have made. So that's how you can stress test this entire thing and check what is going on with entire universe of the portfolios you have added into the risk versus return tab. And what about the scenarios? You might want to check the risk, and you might want to check the scenarios as well. So let's say we check in the a particular scenario as COVID. So what would have happened? What was actually based on historical back test, we can just check in for COVID, and we can see how the performance has been after the COVID. After 23rd March, after the lockdown happened, what was the actual performance. So you can just make it for, let's say, 6 months. So we are just gonna take in for 3 to 4 months, and we can sort it, and accordingly you can see based on the absolute basis, our diversified portfolio was the second best against the others which we have currently right now. So that's how you can actually see the scenarios. Based on that, you can add in the dates. You can even analyze these dates to see what is the annualized return altogether, and you can save this entire data set into an Excel, so that you can use this into your own PowerPoint presentations. because as you all know, you can actually make a PowerPoint presentation seamlessly for any client, and this is pretty useful to give a client his own portfolio scenario, that where his client is, standing in the times of scenarios. That's how you can use and download this data altogether. So that is how this works out. You can make a proper customized analysis accordingly. And the important thing here is that to 1 minute. Okay. And an important thing here is to also check the rolling analysis, because we have all checked all the functions we have checked, like risk versus return and point to point. These are all point to point analysis. So what about the on the rolling basis? What is our volatility? So by the way, we have released two more things, so which we want to speak about is rolling volatility for the multiple securities and return by vol. So what it helps you in is that, let's say we volatility. So from 2013, for a 1 year period, in a rolling sense, how the volatility has been rolling for every single 260 days period. So that's how the volatility works out. And you can actually see one of the highly adventurous, model portfolio is actually highly volatile. And you can see the volatility shoot up within this COVID point of the time. So you can see it is from, February, and, it started shooting up in March and April, and then it came down again. Now, why this is very, very important? Because volatility is not static. Volatility changes based on the time, and time is a very important factors in our entire series of analysis. So here you can actually check which particular asset is having the lowest average vol. Accordingly, you can see one of them is our diversified portfolio, which is the second best altogether. And that's how you can actually take a call as to if we are looking forward towards a lower vol portfolios, which one are these? And that's where you can see the consistency of the portfolio, either a consistent volatility, either a consistently high volatile portfolio or a consistently low volatile portfolio altogether. So that's how this is very useful. And one more important thing is, based on the risk, what kind of a return are we generating? Because that is also very important. So that's where the return upon vol comes in, where you can actually, that's just a ratio upon return upon volatility, which is the risk. And you can just run this up. And once you run this up, the higher the average, the better is the portfolio altogether. So you can see the diversified portfolio I've made is actually giving me a better return upon the volatility which I'm having. And based on that, I can actually show to my client, I can just make an Excel, or I can just screenshot this option to add this parameter into my own customized PPT. And that's how this is pretty useful if you are looking towards the diversification. A portfolio comparisons is one of the tab which is used here. Compared to portfolios, it's pretty easy. You can create a PDF out of this. But one important thing which I've shown you is also the comparisons of multiple portfolios. So I'm just going to show you this PPT, this PDF first, to show you comparisons. So this is the comparison report, a comparison report of the two portfolio. One was our client, and another was our diversified portfolio. And you can see how the annual return difference it has been against the client as well. And by the way, you can also do this exercise just by taking a bit of a time and adding them as a custom securities to compare multiple portfolios, and then come up with certain sets of analysis, just like return by vol, to actually take a call as to what type of a return I'm getting based on the volatility I am actually observing in my portfolio. And that is pretty very useful. You can actually use it. And one of the important thing is also a return format, where you can check what is the average rolling return the portfolio is generating. If the average rolling return is good, it's pretty much evident that this particular portfolio is actually having a good positive percentage. As you can see, a good positive percentage are these two portfolios altogether. So essentially, we are taking lesser risk, getting a higher average return, and that's what our entire aim is when we look towards diversification. And that's how you can take a call on this. So this is it for the entire comparisons of all the multiple model portfolios. You can also add in as many portfolios as you can, even some customized securities, to compare them and see how diversifications are working out. And even you can do one important set of analysis. Now, let's say I have two strategies in mind. One is a diversified portfolio, and a client also has another, set of strategy that I want to invest in debt. So what you can do is you can just, take all this diversified. What if your client wants to invest only 60% of the corpus in the diversified portfolio? A 1 crore is, in the 1 crore, 60 lakhs is going towards diversified portfolio, and other 40 is going towards debt. Maybe let's say parking the money. So, what we can do is we can actually make a second level analysis. To make a second level analysis, all you have to do is just specify, just add in the diversified portfolio. This is just a stress test, that what if the client asks you that what if I invest here 60% and then 40% I go for debt and some other, liquid funds or overnight funds or all together. So whereas what you can do is you can just add in some liquid fund. So I'm just gonna add any simple liquid fund altogether, and that is my 40%. Now this is just a simple scenario where you can run in, and whereas you can check the performance accordingly and also check the drawdowns as well. So how much type of a risk, it is reduced due to that, particular fund you have added, into this particular strategy. So it's pretty useful because this diversified portfolio consists of the entire sets of, universe of foreign securities and ETFs, and all those, highly risky mutual funds like small caps as well. So, this is how you can plan it out for any such portfolios. Even one use case is that you can add in more, like gilt, like in the debt, you can add in some gilt securities to see what type of a risk the client is exposed towards. And you can also see the asset allocation in debt. And that debt is also, already know that it is coming from HDFC liquid fund. And you can see the entire debt securities which is with that particular portfolio is exposed towards. So this will be more useful when you add in more debt securities, altogether, not just one. Let's say you add in some money market and, overnight fund and all together, and that's how you can test it out. Or what if your client says that I want to invest 30% of this, and maybe, another strategy which is highly risky strategy, altogether, like say this one, as highly adventurous strategy, as 20% and then 50% debt. So this is how you can stress test your strategies based on the, analysis which we have given at engine. So, that is how this works out, and you can run this entire portfolio and see that if the client goes towards these two sets of portfolios, and, then you can run the analysis and see what type of returns and the risk we are exposed towards. And very useful way to see the risk is to look towards historical annual VAR, which shows you that in a confidence interval of 95, there is a 5% probability that this particular portfolio can have a drawdown of negative 20.86. You can just make it 99 to see the worst kind of a risk, and it's just 36.45. And if I check the risk of any such large cap fund such as Mirai Asset, right? I'm just gonna add in one of this fund, large cap. You can actually see there is a huge set of difference between portfolio you have generated for the client and one particular fund. And that's definitely it. So you can see the risk is negative 45 instead of 35 against our portfolio. So that's how this works out. And by the way, the Mirai asset is also it also has some exposure in our diversified portfolio, but that's how the diversification is possible by using such tools. So I have completed all the topics which should be covered today. We can start with our Q&A session. So you can actively ask, via chat or via verbally, and we would address them up. So are there any questions? Sure. So in rolling section, what is the difference between point to point and simple returns? Sir, the very important thing, it's a very important question. So what you can do is, like in the simple returns, every data point, let's say this one, like, as you can see, 56.51 shows you the sum of the previous 260 days return. It's a simple addition of every single day's rolling returns altogether. So that's how this simple returns is. But point to point is what it does is that it takes into account the NAV of the first day and the NAV of the 260th day, and then gives you a particular set of return altogether. So this shows you a basic, if you can say, in a very simple sense, it is a rolling CAGR. So every single data point shows you a rolling CAGR altogether. That's how it is point to point. And why this is different than simple return? Because in point to point there is a compounding effect, and due to that you can get a truly skewed numbers altogether if you have a true high rolling window. Whereas in simple returns, all the compounding effects are negated, and you can actually compare each set of fund in a pretty simplistic manner, in a pretty concise manner. That's why we always recommend to use simple returns rather than going towards point to points. But we have given point to point returns by recommendation of some of the advisors, so we have just added that into the returns. There's another question. Yes, currently, Pramod sir, the custom securities which are created will not have the updated values. So that is why it is written as, we have given as a customized securities. You have to update them, once you when it outdated. But we are coming up with some functions which will actually help you to automate this custom security. So our product team is working on that. So soon enough you will definitely get one of the updates from our side with a particular email. Are there any other questions?
I think there is no questions, Umar.
Sure. So it seems okay. How can we upload the portfolio? Okay. So to upload portfolios, there are a couple of ways. One of them is to add a new portfolio. You can come into the add a new portfolio button, and here you can click on this upload options. Now there are two sets of options. One is a you can actually type in the couple of securities and make a portfolio. That is a manual way. Another way is to upload the portfolio directly from CDSL CAS PDFs, NSDL CAS PDFs, and CAM summary report. So all you have to do is click on it. You just have to add file and add the file password and upload the CAS statement, and that's how the portfolio gets onboarded in this particular white box. So it will look something like this, and that's how this works out altogether. And there is also one more option, which is ISIN from Excel, which is pretty accurate and pretty pretty much very powerful. So all you need is percentage and the ISIN number, or an amount and an ISIN number, or a unit per share and an ISIN number, and you just have to validate the input, and the portfolio gets onboarded very seamlessly. You can effectively run multiple sets of portfolio together. Are there any other questions? Okay, so it seems like we do not have questions. So if you have any questions, we will definitely address them into the next session. Please do visit on the next session. We will be having some more insightful and very interesting topics to show you how to effectively use these powerful functions and come up with, a certain set of advisory which will, benefit your business as well. And, reviewing the portfolios are very important, because that's how you can stress test and you can see the strength of the portfolio altogether. So we recommend you to visit, keep visiting our webinars. So thank you so much, everyone. We will tentatively visit in the next session, next Friday. Um, yes, ma'am, Devi ma'am, we will be, we will connect with you for explanation of the portfolio comparison. And our team will connect with you after the session. And so we will explain this particular topic. So thank you so much, everyone, for visiting this webinar. Next Friday, we will visit again and, hopefully give you a proper insights about our developments and all our plans and how to use this software effectively. Have a nice weekend, everyone. Thank you.